Hello friends, this is Dr. Amarjeet Kaur. I am Professor of Accounting and Business Communication at the Department of Management, Gurugram University, Gurugram. This is my privilege that I am here with you to talk about net present value technique of capital budgeting. So friends, net present value technique is the most commonly used technique in evaluating of proposals of long-term investment, be it investing in a building or a plant or a machinery, etc., etc. So whatever falls under the category of long-term investment or fixed assets most of the times, the decision pertaining to them are taken by using a most commonly technique net present value. This is not the only technique, of course, there are many more techniques of capital budgeting, but as I said, it is most commonly used technique. So in NPV, what do? We compare present value of cash inflows with present value of cash outflows, and then we actually compare the two of them. If present value of cash inflow is more than the present value of cash outflow, the project is likely to increase shareholders' wealth, which is the ultimate objective of financial management, right? If the project is giving us at this time when we are calculating a negative cash inflow or negative present value, means our cash inflows are less than my cash outflows for that project, then it is likely to not help us in generating shareholders wealth or maximizing shareholders wealth. In that case, it is suggested to reject the proposal. So net present value is an important technique because we are using three important things in it for calculation on NPV. We are considering time value of money, we are considering discount rate, which is by taking care of the risk and the return element of a business, especially the risk of the funds, the cost of funds business is using. And then we are using cash flows, the discounted value of cash flows, that is what the present value of cash flows. So these are the three important concepts behind NPV, right? So basis on that, a business decide to accept or reject a long-term proposal, which is capital budgeting decision. So in this session today, we are going to take about two cases or small caselets to learn how the NPV is actually calculated, because in the past, in the previous session, we have already discussed all the nitty-gritties of NPVs. You may refer that session in the which has been covered in the past if you want to learn about the concept of NPV and the calculation part. We are going to practice today in this session. So I am going to take up a caselet of NPV. It is a case of Watram company. So the case goes like this: Watram company has been offered a 5-year contract to provide component parts for a large manufacturer. The cost of special equipment is 160,000. The working capital requirement is 200,000. The relining equipment in 3 years is 30,000. The salvage value of the equipment in 5 years is 5,000. The sales revenue from parts is 7,50,000. Cost of parts used is 4 lakhs, and the salaries and shipping cost is 2,70,000. And in addition to this information, the other information is that at the end of 5 years, the working capital will be released and may be used elsewhere by Watram. The Watram company uses the discount rate of 10%. So the question is, should the contract be accepted or not? So the data we have been given, if you have noticed, we have been given the cost of the equipment, which is 160,000. The working capital required for this project. So this 160,000 of which is the cost of equipment is cash outflow, right? Working capital required today, which is additional of 200,000 is or 2 lakhs, is also a cash outflow. Then relining of equipment, we need to reline the equipment after 3 years, which is, and we are going to spend 30,000. Even that is outflow. The salvage value of the equipment in 5 years is 5,000, which is a cash inflow. So, why I am stressing on these things? You cannot attempt to solve a situation or a case or a question on NPV unless you actually are able to make a difference between cash inflow and cash outflows. So, that is why I am discussing one by one that what is this item. So, either this falls in the inflow category or outflow, and that you should have your common sense. It is not a rocket science which I am discussing, right. So, one can easily assess that either it is a cash inflow or a cash outflow. And then the sales revenue is of course cash inflow, but sales revenue is not what we are going to consider in calculating of NPV. We need cash flows after tax, right, CFAT. So, if we have been given CFBT, the cash flows before tax, we need to convert them to the cash flows after tax. That is what we consider in the NPV calculation. Then the cost of part which is required is 400,000 and salaries and shipment is 270,000. So, total cost, the incremental cost is 400,000 plus 270 means 670,000 and the incremental revenue 750. So, 750 minus 670, which means my net cash flows after tax are 80,000 per annum, right. That is most important. And for how many years I am going to get them? I am going to get them over the life of the project, which is 5 year here. And after 5 years, I am recovering salvage and my discount rate is 10%. So, let us now have a look at that how would we solve this problem. The calculation of NPV. So, just ignore this initial outflow of 200,000. This is not required here to be referred. This is an additional information which must be ignored. So, please ignore that, just refer to the table which I am showing you here. So, the annual net cash inflows for 5 years is 80,000. And how did we calculate this 80,000? We just discussed that 750,000 is the inflow which is incremental and 670 including the salaries is the cash outflow. The difference between inflow and outflow, the incremental revenue and the incremental expense is 80,000. So, this is how we calculated this 80,000, but 80,000 is not received only today. It will be received for 5 years in future. So, for 5 years, if we are getting the same amount without any interval, like with the same time interval, it becomes an annuity. To discount this 80,000, we will be referring to annuity table, right. So, the discount factor here which is given in the table 3.791, it comes from where? It comes from the annuity table at the rate of 10%. So, 3.791 is the discount factor. So, if we multiply 3.791 with 80,000 which is the cash inflow in annuity format 5 years, my total amount comes in 3,03,280. So, this is the present value of only the incremental cash flows or cash flows after tax CFAT. Then the second cash inflow was the salvage which we just discussed few minutes ago, which is happening in year 5, right. So, there is a column of year. If you look at carefully, there is one column which is giving the details of particular, second column is year, the third is cash amount, the cash flows, and the fourth is the discount factor, and the last column we are calculating the present value. So, the second cash inflow which is happening after 5 years from now is 5,000. So, how would you discount it? Just think about it. In the previous one which I just explained you, 80,000 was happening every year, year on year basis, and it was annuity, and that is why we used a factor from annuity table 3.791. But this 5,000 is happening only or is being received back only once, which is in the terminal year at the end of the life of the project. So, we will be using the discount factor from 1 rupee table, and that is 0.621. So, if we multiply 5000 with 0.621, which is the discount factor, my present value comes in 3105. Then the another cash inflow, which if you remember the case, if you have heard me well, the working capital is released after 5 years. And how much was the working capital? It was 2 lakhs. That is initial outlay of 2 lakhs on working capital, right? It was 2 lakhs. So, we are going to discount it with the factor which we chose, which we will be selecting or will be actually picking up from the discount table. Again, the table here, I must emphasize, there are 4 tables which are readily available in every book of financial management, right? You refer any book on this earth. And there are 4 tables. The first 2 tables are the compound value for 1 rupee or $1. And then we have compound value of an annuity table, the table number 2. Table number 3 is always for discount factor for 1 rupee or $1, and the last 4th table is discount factors for an annuity, right. In NPV case, we are using last 2 tables, table number 3 and table number 4, which is discount factor of 1 rupee or discount factor of annuity, depending on what type of cash flows we are talking about. The cash flows after tax, which is annual net cash inflows, which we just used, 80,000 was annuity, whereas salvage was not an annuity. That is why we will be using table number 3, 1 rupee discount factor for 1 rupee. And so is for working capital, because it is also being received once in the terminal year. 2 lakhs gets released after the project is over, right. So, we are going to take the table number 3, which is 1 rupee discount factor. So, discount factor for 1 rupee table. So, 0.62, again if we multiply 2 lakhs with 0.62, we get 1,24,200. These are our cash inflows. Now, coming to the cash outflows. So, initial working capital requirement was 2 lakhs, just ignore that outlay word at the top. Now, coming to the outlay, coming to the requirement, the first expenditure or first outflow is the equipment cost itself of 1, right. So, 1,60,000. So, we are spending it today, the time value is 0, today is always 0, and discount factor for today is always 1. We need not to refer to any table, you need to remember it, be it compounding or be it discounting, both are the techniques in time value money, right. Whatever, either we want to discount or compound, the discount factor is 1 for whatever the funds being received or paid today. In future, year from now, 2 years from now, 3 years from now, discount factor changes, right, for inflows and an outflow both. So, the investment in equipment is 1,60,000. So, the present value factor for 1% for 10% rate of discount is 1. It means my present value is 160. Same is for working capital requirement, because we are using working capital today to run the project. So, 2 lakhs of working capital, the discount factor remains 1, multiplying 1 with 2 lakhs, you get the 2 lakhs amount of present value for the working capital as well. And then third thing was that we are going to realign the equipment. So, realigning of equipment in the third year, which is 30,000, here I need to discount, because it is happening not today, it is happening 3 years from now. So, the discount factors for 3 years at 10%, if you look at the table, it would be 0.751. So, multiplying 30,000 with 0.751, the 22,530 is the amount which is actually present value of the equipment realignment, or otherwise overhauling or repair. Realigning is kind of repair. Okay. So, these are the total outflow. So, if we total outflows and we total inflows, the discounted value, of course, the present value of inflows and the present value of outflow, which was there in the last column of the table. The difference between the two is net present value. In this case, it is coming out positive, 46,000 something 55, right. So, it is there in front of you. So, this is the 48,055 is your positive present value. So, what was the question? The question was, ask either this company, what term should accept or reject the proposal or the project. Now, what do you think we should accept or reject? Tell me, just think about it. So, it is very simple that we should accept it because the NPV is coming out to be positive here, right. So, as the rule says, the criteria says, so we should recommend it for consideration of acceptance. But will the company accept it or not based on NPV only? It is up to the company. But there could be certain more factors, maybe political factors, maybe legal factors, that company is not sure about the location or situation, company may not accept it. So, it is not a binding, NPV does not say it is a binding of for a company to accept it. But if we evaluate this proposal from the finance perspective, from shareholders wealth maximization perspective, then this proposal should be accepted, right, barring other factors which also do play an important role. So, while excluding those factors basis on the financials only, this project should be accepted. So, we will take one more caselet, another caselet where the cash flows are happening every year on a different, in the previous note, in the previous case, the cash flows after tax was 80,000 every year, right. We are going to take up a case where cash flows are in a mixed form, right, they are happening differently every year. This is a case of a company which is considering installing a project or investing in a project, right, requiring the working capital so the initial outlay of 2 lakhs, and the cash flows after tax are given in year 1 lakh, year 2 2 lakhs, year 3 80,000, year 4 80,000, year 5 40,000, and we have been given the discount factor as well, 0.909, 0.85. So, have a look at the slide. So, we have been given 5 years, we have been given data of cash inflows for each year, which is different, which is not consistent. In the previous case, the cash flows after tax was 80,000 per year, yeah, I hope you remember. But here in this case, our cash flows are different every year. And luckily in this example, the discount factor is given, that we need not to go to the table, 0.909 to the last one, 0.621, right. So, we are required to calculate NPV with additional information that depreciation is charged at 20% on original cost of the machinery, and the taxation is 50% of the net income. So, what should be the NPV? So, since the top of the table, that the initial line says the below are cash flows after tax and initial outlay is 2 lakhs, right, which means the rate of tax and the rate of depreciation which is given to us is to make us confused, or to just to confuse us. So, it is a trick which has been played in this case, right. So, remember, the point I am making is this, remember that we use cash flows after tax, we do not use cash flows before tax in calculation of NPV. If cash flows before tax, which is CFBT, if that is given, then we need to convert the CFBT into CFAT by referring the tax rate and by referring the applicable depreciation and the method as well. So, the last 2 lines of this case are to confuse you. So, since it is we have been given the CFAT values for every year, we simply need to discount it, which is not difficult at all. So, if you look at the table where we are solving this case, the initial outlay is 2 lakhs rupees, right, as the case says. So, the investment in the project in the first year is 2 lakhs, which is initial outlay, and the value of the discount factor is always 1 for today, for 0 period. So, it means my present value comes out to be 2 lakhs, which is in bracket, means it is an active value, it is an outflow. Then CFAT for year 1 is 1 lakh, for year 2 is 1 lakh, and the discount factor we have been given. So, we just took that discount factor given 909 and 826, which is given. We take from the table and we multiply the discount factor with the cash flows after tax for year 1 and year 2. So, we get the value of cash flows which converted after discounting them. The last column is giving you the value, that value is actually your present value, 82,600 and 90,900. Then the cash flows after tax for year 3 are also given, right, 80,000, and for year 4 are also 80,000, but the discount factor would be different, right. The cash flows are same for year 3 and year 4, discount factor is 0.75 and 0.683, whatever it is, right. We multiply the factor with the cash flows and the last column is actually giving you the present value. So, lastly in the 5th year we are getting 40,000 and the discount factor is 0.621. If we multiply this factor we get 24,000, 840 as a present value. If we sum up all these present values of cash flows after tax and we subtract them from the initial outflow of 2 lakhs, the difference is 1,13,060, which is our net present value, which is positive. So, which means basis on this net present value technique for the given case, it is recommended to accept the project. If the same value would have been negative, we would have recommended not to accept the proposal, right. I hope you could make a difference between the two cases. In the first case, my cash flows after tax were given and they were same for all the 5 years, 80,000, and that is why we use annuity table and we discounted it. In this case, the cash flows are uneven. Year 1, 1 lakh, year 2, 1 lakh, year 3, 80,000, year 4, 80,000 and year 5, 40,000. So, there is a difference. So, that is why the discount factor is taken separately for every year, because time value of the cash flows happening after 1 year is different than the present value of the cash flows happening after 2 years, because the discount factor would be different. So, that is why we have discounted individual cash flows after tax for all the 5 years, and then we have summed them, the sigma, we have make a summation of cash flows, the present value, in fact the present value of cash flows, and we subtracted the cash inflows or the difference of present value of cash inflows and cash outflow is your net present value, which has come up as positive. So, project should be accepted. So, now in these two cases, important was that we were given cash flows after tax in both the cases. In the first case, the cash flows after tax were given, but they were same, that they were in the form of annuity, 80,000 every year. In the second case, the difference was we were given cash flows after tax, but the cash flows after tax were not same, or they were inconsistent, they were in the mixed form, like 1 lakh, again 1 lakh, 80,000, 80,000 and 40,000. So, there was a difference, but in both the cases cash flows after tax was given. So, what will happen if the cash flows after tax are not given? You have been given cash flows before tax, what would you do in that case? So, I am going to explain that how to calculate or how to convert rather cash flows before tax to cash flows after tax. We will take up some example and I will explain you, because this is important. This is a lengthy process, converting cash flows before tax to cash flows after tax. So, I will explain this with the help of a good example. So, refer to the slide here. ABC Limited is considering an investment proposal to install new equipment at a cost of 50,000, which has a life of 5 years and it has no salvage value. Further, the tax rate is given at the rate of 35%. So, this is the data given that ABC is considering investment proposal to install a new equipment, and the cost is 50,000, right? And life is that N is 5 years and no salvage value is there. So, the rate of tax is 35%. What are we supposed to do? We are supposed to calculate cash flows after tax, because their cash flows before tax are given. Further, that we have been told that assume the firm has straight line depreciation method, and the same is used for tax purposes. So, we are supposed to calculate cash flows after tax. So, let us have a look. This is the data given year 1 to year 5, and CFBT is very important. We are learning to calculate CFAT, cash flows after tax. But what is given? CFBT, 10,000, 10,692, 12,769, 13,462, 20,385. This is the cash flows before tax. To convert it, have a look at the table. I have put all those 5 values of 5 years in the column number 2. First column is year, the second column is CFBT. The third column is that we calculate depreciation by using straight line method. Since the value of the equipment is 50,000, life is 5, if we divide 50,000 with N, which is 5, the depreciation per year comes out to be 10,000, right? Now, profit before tax, if we calculate tax on the CFBT after depreciation, the profit before tax would be nil, 692, 2760, 23462, 10,000, which means cash flows before tax minus depreciation, that is profit before tax. So, on this value on the column number 4, if we apply the tax rate at the given rate of 35%, we get the tax amount in column number 5. Since the revenue PBT is nil in the 4th column, the tax would be nil, of course. Then on 692, 35% is 242, on 2769 the tax is 689, and so on. So, what is happening after this tax? The amount left with us is PAT, profit after tax. The second last column is profit PAT, which is profit after tax. And lastly, what we do, cash flows after tax. How do we get that? The PAT plus the depreciation, the column number 3 and column number 6, they are added together, PAT plus depreciation. If we add them up together, we get cash flows after tax. So, that is how we actually calculate the CFAT. So, the purpose of this session was to help you understand how do we use net present value in 2 different situations, and also to help you learn how to calculate cash flows after tax. With this, I would like to wind up, friends. Thank you very much for for your kind attention and for your presence. Thank you very much.